From New York City for our viewers worldwide, a very good morning. I'm Manus Cranny. The issue for Starbucks, it's a bit of a drag. You're just not buying enough matcha lattes. That stock is getting trounced, down 13%. There's a quavering in this market. We're counting down to the FOMC. What will Powell's pivot be, if at all? Countdown to the open kicks in right now. Coming up, markets are on the edge after suffering the worst month since September. Better than expected results from Amazon failing to move the needle. And investors look ahead to the Fed and Chairman Powell's news conference. We begin with the big issue and debate, the health of the U.S. consumer. And it is about two stocks today, Amazon on the tech side, Starbucks on the consumer side. Let's kick off with Amazon. It is about the cloud unit reporting the strongest sales growth in a year. But it did not move the dial materially. Ed, why?
Yeah, it's sort of not a hyperbolic reaction. Second quarter sales outlook was below consensus estimates, and the street looked past that. They looked at cloud, as you say, because following Alphabet and Microsoft, the situation for Amazon was a show-me situation. Are you actually making any money from generative AI? The answer being yes. The two data points we got are that AWS, which is the market leader in cloud, has a revenue run rate, annual run rate of $100 billion. It was a $90 billion business in 2023. And it was just one phrase from the CFO, Brian Olszewski, on the media call that I was on, which is generative AI has a revenue run rate in the multiple billions of dollars. And that seems to be enough with the stock up 3% in pre-market to convince investors that all of the investment and hype around AI is now materializing in top-line growth. And there was top-line growth in cloud. You talked about the consumer. Go back to that second quarter sales outlook being a little bit weak. Yep. The e-commerce business slowing a bit. And what the narrative is that consumers are trending down in pricing, going for the cheaper options, being selective where they spend. And I thought that was interesting. And that is the fissure that we're trying to understand whether it grows. Ed, thank you very much. Amazon top of the block. Another one that's moving today. It is Starbucks. Sales falling for the first time since 2020. Consumers are becoming more budget conscious. The CFO said this: we were not pleased with the performance this quarter. We really sharpened our focus, and we have a clear path going forward for growth. Danny Berger is with me side by side. We debated this morning in detail. You're not spending enough on your matcha latte.
Or maybe I'm spending too much.
She's spending too
Manus.
much.
Maybe that's really the problem. I looked this up for you because I know you'd want to know. I got out my Starbucks app. I looked at how much a lavender matcha latte would set you back across the street. $6.75, Manus. And look, we can joke about this.
$6.75.
I mean, it's painful. And we can joke about this as much as we want, but what it clearly shows is the loss of pricing power. If a consumer is feeling the pinch, they can just as well go home and make their own coffee. They're not necessarily going to pay up for that pricey latte at Starbucks. So it's a consumer that we're seeing this pain across different companies too. McDonald's talked about this in their earnings call. Amazon even saying that consumers were trading down. So shares falling nearly 13%. Manus, the analyst comments were brutal. William Blair downgrading it, calling it a stunning miss across the board on all key metrics. Vital Knowledge calling it the worst set of results of any large companies so far. Even had a huge miss in China too. So the CFO goes on trying to reassure investors, saying essentially that the way we're going to get people back is we're going to be more productive, get them their coffee sooner, and introduce new items for the summer, things like boba tea. So I hope you're ready to shell out $10, I'm sure, for some bubble tea, Manus.
She can bring me bubble tea one morning. I think the most brutal line that I read was from Citi. Starbucks is putting a lot of oars in the water to try to paddle. Brutal times. Danny Berger there, keeping the Starbucks dream alive. Another big story that we're tracking, it is, of course, counting down to the Fed. Mike McKee is with me from Washington to break it all down. We've had a quarterly refunding. We want to know exactly how hawkish the dovish pivot is from Powell, if you can put those two oxymorons together.
Yeah, if the dovish pivot goes away. Well, we got some economic data this morning that suggests Fed does not need to cut rates. ADP employment, 192,000 for the month of April. They don't always compare very well with the non-farm payrolls number we will get on Friday. But in this case, they're very close. It was 192,000 for ADP. And last month for the non-farm payrolls, private payrolls, 190. So it looks like they're pretty close to where the consensus is for the overall economy. And that'll give the Fed pause as they meet today. There are a number of other indicators they'll be looking at. And the meeting did start, by the way, at 9 o'clock, according to the Fed. We've got S&P PMIs coming out at 9:45. We'll be back for that. Construction spending, JOLTS, and ISM manufacturing, both very important. We'll be looking at the prices paid number for ISM. Put it all together, and the Fed is probably not going to move today. That's the expectation. But this is going to be a question of what do they do for the future? What do they do the next time? And there is only one clue to that today, and that's Jay Powell. There's no projections and no dot plot. There are a lot of questions, though, and this gets to what you were talking about, the dovish, hawkish level. Why is inflation so sticky? How long is for longer, high, is policy restrictive enough? And would you consider raising rates? He'll get asked that. If he answers that, Manus, we'll all go to Starbucks and Jay Powell will pay because he's being told not to talk about that, I'm sure. Also, one last thing, and that's they may announce today the official start of the taper of the balance sheet. They've already said they're going to do $30 billion, move the cap down from 60 to 30 billion. It's just a question of when that begins. So that may be a little bit of news that Treasury trading desks get today.
I think on that question, Mike, it's going to be a lot of obfuscation and creation of ambiguity around the debate on a hike. Mike McKee, he'll be back with us a little bit later on with the data. Matt Hornbach is with me, Global Head of Macro Strategy at Morgan Stanley. Look, there's a hot ECI going into this, a strong ADP going into this, but we are short up to the yin-yangs going into this. So this market, what is the reaction function if he holds the line and keeps the two cuts dream alive, the insurance cuts? Matt, good morning.
Good morning, Manus. Thanks for having me on the program. Look, I think the data needs to be contextualized with some of the immigration data that the CBO put out earlier this year, as well as the strong level of productivity growth that the economy's enjoyed for the past year. I think if you think about the employment cost index in that context, it could very well be the case that this level of wage inflation is still consistent with 2% inflation in the mind of Chairman Powell. So I do think that his message ultimately is going to continue to focus on easing the nominal rate policy later this year. Bear in mind, just because they're cutting nominal interest rates doesn't necessarily mean that they're going to be easing the stance of monetary policy, because they think about that in real terms. And so as long as inflation continues to move back towards 2%, I do think, in which we think will be their baseline forecast, then we should expect the Fed to begin lowering interest rates later this year. And that's what the message will be, we think, coming out of this press conference.
Have we lost sight of some very simple facts, which are the Fed was targeting 2.6% on PCE? And this is what State Street suggested, that was for this year. And in actual fact, it is at 2.8%. The distance, that gap is small to jump the Rubicon to start the cuts.
Well, I don't think the Rubicon is particularly wide in this case. Our current projections for what the Fed will think about core PCE inflation later this year suggest that they'll move up those forecasts just a tenth. But again, that's not enough to get the Fed interested in hiking rates. And I think the other issue we need to bear in mind when it comes to the prospect for additional rate hikes is that if the Fed decides that more rate hikes are needed, you better believe it's going to be more than just 25 basis points. It's going to be probably much more than that. And so that's a very tricky situation that I think they'll want to avoid until they really believe that another 100 basis points of rate hikes are necessary.
Do you believe then, with the narrative you've just given to me, if I look at if I look at 2s over 5%, I look at 10s, I mean, they're clutching, they're desperate to get to 475, and they may even test that new band with 475 to 5. But with the narrative that you've just given to me, therefore I should be incrementally adding to duration. If you think we're at the top of the mountain, I know you say it's different this year relative to the summer of last year in terms of the spike of yields, but if you put it together, is that the correct extrapolation of what you've said?
Absolutely. I mean, these are fantastic levels for investors These levels have come about as a result of the higher inflation we've seen year to date. But investors also need to bear in mind that the statistical agencies, the BEA, the BLS, they have issues adjusting for seasonality in the inflation data set. That applies not just to consumer prices, it also applies to employment costs. And so we need to bear that in mind. So I think the Fed will be relaxed about this uptick in inflation, and the market hasn't been relaxed. And that's exactly what presents the opportunity for investors to add duration to their portfolios at these levels.
I was looking at the 1 year forward. This is something that Stephen, over at HSBC, we've had this video out from Stephen Major this morning. He talks about the 1 year forward as being the real anchor in defining where we go next in rates. When you look at the risks in this market, the 1 year forward is very, very stoic at the 4.6 level, 4.7 level. What is it that will change that narrative? Because energy complex is volatile and risky, but what changes the outlook?
It's definitely inflation. The labor market strength is notable and I think speaks to the immigration story that our economists have been highlighting. But I would say the real issue for monetary policy and hence for the direction of bond yields is going to be the inflation data. That's been the primary driver of higher yields year to date, and we suspect it will be the primary driver of lower yields as we make our way into the end of the year.
Okay, Matt, thank you so much for being with us. That is Matt Hornbach of Morgan Stanley. Let's look at some of the stocks that are moving ahead of the bow. We've had our fun with Starbucks. Abby, take me through your view.
And we'll be taking a look at Starbucks once again. But first, let's take a look at one of the big winners on the day. And of course, you were talking about this earlier at the top of the show. Amazon shares are higher. This is all about the cloud beating because their adjusted earnings actually missed in a significant way. The guide is disappointing, but you can see the stock up 3.8% on that 17% cloud growth. They put up $25 billion in AWS revenue, better than the $24.1 billion expectation. To the downside, though, it's not just Starbucks. Take a look at CVS, absolutely plunging down 13%. They put up a 23% miss for adjusted earnings. They missed sales. They cut the outlook much more than expected, and it looks like those Medicare pressures are persisting for CVS. And then there is Starbucks, also down 13%. That stunning miss right across the board, U.S., China, and as you and Danny were talking about, they are going to try to bring in more products to stimulate people coming in, but will it work? That sometimes when you do too many things and you're not doing just one thing right, Manus, it could be a problem. Indeed, indeed. Abby, thank you very much. Coming up, KKR topping Wall Street estimates in the first quarter. So we sit down with Robert Lewin, the CFO. That's next on Bloomberg. So it's a beat for KKR in the first quarter against the estimates. The asset manager changed how it relays its results. Sonali Basak has the CFO in conversation. Sonali.
Thank you so much, Manus. And Rob Lewin, KKR CFO, is joining us now here at Bloomberg. And you have your profit topping estimates. You also have assets under management topping estimates. Puts you on the way to reach the goal you've laid out at KKR to reach $1 trillion worth of assets in the next 5 years. Rob, is there anything that changes here in this higher for longer environment in terms of how you meet these goals?
Sure. Well, Sonali, thank you for having me on this morning. Maybe we'll start with the headline of the day. Our quarter is a really strong quarter for us at KKR across our core financial metrics. Even more encouraging is our forward-looking indicators. And so if you look across our three core profitability measures, that's fee-related earnings, that's total operating earnings, adjusted net income, all of which on a per-share basis were up between 20 and 28% year on year. So really strong quarter in that respect. But even more encouraging is what we're seeing going forward. We raised $31 billion of capital in the quarter. It's the second consecutive quarter where we've raised over $30 billion of capital, which is actually the first time in KKR's 48-year history where we've done that in back-to-back quarters. So really bodes well for the future.
We've written a little bit here.
And then finally, and most importantly, Sorry, go ahead, Chanel.
Yeah, we've written a little here about your fundraising plans here. I know you can't talk about fundraising plans publicly, but privately we know that you're on track to raise more than $1 billion here, or roughly $1 billion for an infrastructure fund. Rob, can you give us some picture here about where investors are putting money to work? Where is most of this fundraising coming from across assets?
Sure. And so the interesting thing is, if you look at KKR since the beginning of 2022, we've raised about $180 billion of capital, which is a really healthy number for us. But we've been able to do that without a lot of our large flagship strategies in the market. So as we've talked about the go forward, we've talked about fundraising being able to accelerate from here. If you look at where a lot of that capital raising has been over the course of the past number of quarters, in Q1, we had a final close of $6.4 billion in our Asia infrastructure strategy. That's the largest fund by a good margin in Asia Pacific focused on infrastructure. Lots of real good tailwinds there in terms of longer term growth. A lot of capital raising across our credit franchise. That's asset-based finance, that's direct lending, leverage credit, north of $20 billion in just this quarter alone. So there's a lot of momentum for us across capital raising, and we would expect that to accelerate. What we've articulated to our investors is we believe that we could raise $300+ billion of capital over the course of the next 3 years.
How do you feel about the money not only brought in, but the money that you're spitting back out to investors? Big open question across Wall Street in terms of how quickly firms like yours can be monetizing your assets, selling them, putting them into public markets with this kind of volatility around.
Sure. The important thing to think about when you're thinking about KKR is that we have 4 main investing verticals. That's private equity, that's infrastructure, real estate, and credit. We are also very much a global firm. And we've got, if you look at our investment professionals, north of 50% of our investment professionals today are based outside the United States. So we are always in the market, always able to pursue different investment themes that we have in front of us. Really exciting in that respect.
Do you think, Rob, do you think that this year that investment window can stay this open? Do you think that might be pushed out into 2025 in terms of monetization opportunities with the volatility that we're seeing?
Sure. Let's maybe start on the deployment side, and then I'll move to monetization. It's not what we're seeing. Our pipelines on deployment are building across the firm. We are really active in areas like infrastructure, all things digital infrastructure, so towers, fiber, data centers. If you look, we're really leaning in on the renewables, energy transition side of investing. We just completed our first climate investment in the U.S. in Q1, a business called Avantis in the solar energy storage business. Really exciting opportunities for us across all areas of infrastructure. Asset-based finance is another area where we're really leaning in as a firm. I think there's a lot of really good tailwinds for the alternative asset managers in asset-based finance, and KKR is a real market leader there with north of $50 billion of assets under management today focused on that area.
In terms of, please go ahead. Monetization.
Yeah, sure. In terms of your question as it relates to monetization, again, we're starting to see pipelines build, and in just Q1, we exited a really successful investment for our firm, at least partially exited a business called AppLovin at north of 18 times multiple of money for our investors. So we are seeing real opportunities across the firm to be able to monetize. And likewise, just like we're seeing growing pipelines on deployment, we're seeing growing pipelines on the monetization side as well.
It sounds like you're trying to find opportunities or are finding opportunities regardless of this kind of higher for longer environment. It's Fed Day, Rob. How do you think about what the investment opportunity looks like with rates potentially staying at this level or not much lower?
So one of the unique things about our model, right, is we have over 200 companies that we're invested in across the globe. So it gives us a pretty good lens into what's going on from an economy standpoint. And we're seeing goods inflation come down. We're seeing shelter inflation come down. We are seeing core services inflation remain stickier. And we've been feeling this way for quite some time, and we've been able to position our portfolio to be able to address this. And so we do see interest rates coming down over time, but we don't see any cuts in 2024. We would expect the 10-year to probably come down to somewhere around 4% plus or minus, but all been very front of mind for us as we pursued investment themes. We've been focused on businesses now for some time that we feel can sustain margin in a higher cost environment. You're really seeing that play out in our portfolio, really healthy we've driven real investment performance on behalf of our clients again this quarter and over a longer period of time, so we're quite proud of that. And back to areas where we've been leaning in, asset-based finance, infrastructure, both have a component of inflation protection baked into those asset classes.
Speak to us more about inflation here and how inflation might be impacting your portfolio companies. And we've kind of talked about this kind of potentially higher for longer inflationary environment as well. How are you thinking about investing through that?
Sure. Back to we've got a big global diverse platform, so we're able to move capital around where we think we see the highest opportunities across the globe. As it relates to our portfolio specifically, we feel really good with the health of the overall portfolio. There's aspects of KKR's business that are going to perform better in a higher rate environment and aspects of our business that are going to perform better in a lower rate environment. The key for us, have we set up a firm where we think that we could go out-compete our competitors regardless of the environment, and we feel like we've got the toolkit inside KKR to really be able to do that.
But do you think at KKR you have to prepare here for potentially higher prices across those portfolio companies, and how do you prepare?
For sure, Shanali. Yeah, and we have, and absolutely, I think from a portfolio construction perspective, we feel really well prepared for that. But at KKR, we really have to prepare across different outcomes dynamically. You might be in an environment where interest rates are higher, or you might be in an environment where we're surprised on the inflation side and it could be lower. And so back to how we focus our teams, it's very much real time. The information we have back from our 200 plus companies inform our investment process, and I think allow us to stay really ahead of the curve, which ultimately benefits our clients with greater investment performance relative to the competitors that we're competing against in the market.
Rob, thank you so very much for your time here. And I know you have an earnings call ahead of you as well. That is Rob Lewin, CFO of KKR. Manus, back to you.
Charlie, thank you very much. Great conversation now about how to live and invest in a higher for longer environment. KKR. Morning calls coming up. We've got FS Investments, Troy Gayeski joining me for the opening bell to discuss the outlook for markets ahead of the Federal Reserve this evening. Context matters on Bloomberg. So we know it's a tough time for you out there in Starbucks. You're cutting back on your matcha lattes, but also on Estee Lauder. A big drag. The stock is down now over 4%. So again, there are various fissures here in the outlooks from these companies. Stocks are lower. We're going into Fed Day and what the FOMC has got to say in terms of Chairman Powell's narrative. Some of the calls, JP Morgan upgrades 3M to overweight after the earnings, highlighting stock attractive valuation and strengthening balance sheet. Deutsche Bank downgrades Starbucks to a hold, saying second quarter results point to pervasive and persistent headwinds. Finally, KeyBank upgrading Dollar Tree to overweight, expecting fundamentals to accelerate through the back half of the year. It's hard to believe it's the start of May. Troy Gayeski joins me of FS Investments very shortly after the opening bell. We're going to count down to the Fed rate decision and what does Chair Powell say to the market on Bloomberg. There are fissures beginning to appear in the U.S. equity story. Have we finished with testing the downside? Powell can reaffirm the optionality for cuts still to come. If he does that, maybe that creates a floor. We're lower with Starbucks. We are lower with Estee Lauder. You're just seeing the stock market struggling ever so slightly this morning. We ran by 6 basis points on the bond market yesterday. There is the opening bell ahead of the FOMC and ahead of the narrative from Jay Powell. As I say, does he invoke the spirit of optionality when he speaks later on today after the FOMC comes out with their decision, which is presumed to be no change, but it is about the rhetoric from Powell. Euro is up by 1/8%. The dollar's just giving a little bit back. It had a strong day yesterday on the spike in yields. We're trading back in these yields ever so slightly. We had a moderate ADP number, and we had the Treasury auction, the schedule. It looks like they're upping the size of T-bills, and the overall size of the auction on change, $125 billion. More on that later on in the show. Oil is down. This is about inventories. This is about stockpiles in the United States. 4.9 million up for the 6th week in a row, and a strong dollar rather than anything to do with the potential for Israel joining ceasefire talks. We need more substantial news flow on that front. Look, there's one stock that is really the king of the jungle. It is Amazon. And the stock is rising, posting strong cloud sales growth on AI demand. Ed Ludlow has the narrative. So we now have a figure on the growth trajectory, the expected trajectory for AWS. And that is the strength in this story.
Yeah, that's exactly right. And actually, look at where the stocks opened on this Wednesday morning, and there's a more energetic open than perhaps the trading we got in pre-market. It was a show-me quarter where investors wanted to see tangible signs that all the narrative for AI is manifesting itself in financials. And so AWS has hit an annual revenue run rate of $100 billion. And then the commentary that we got was that generative AI specifically is also on a revenue run rate in the multiple billions of dollars. In other words, they are making money from what their strategy has been in the context of AI. The 1Q beat was significant on the bottom line. Operating income really boosted by the growth in AWS. AWS, the cloud market leader, has always been the cash cow for Amazon, in particularly consistent terms when the retail consumer-facing businesses have faced more volatility. And therein lies the rest of the story, right? The second quarter outlook from a sales context was below consensus. But on the sell side, at least, there's very little discussion of the other parts of Amazon's business other than the strength in AWS, particularly from a bottom line perspective, can offset some of the margin headwinds that the retail division is facing. And I'm sure you'll talk about Starbucks and some of the other consumer stories out there. If there was one story about the consumer, it's that they're being selective at what they're buying on Amazon.com at the lower price point. Once again, advertising is a bright spot for Amazon, 24% growth in ads in the first quarter. And note that this was the first quarter where Amazon put ads on Prime Video. There seems to be some evidence that was successful. The stock actually paired its early gain up 2.4%.
Got to say, the adverts are a little bit interrupting and jarring. I think I might upgrade to the ad-free zone. But that's the whole point about it, isn't it? What level of interruption will you have in your viewing? We could never be interrupted viewing Bloomberg Technology with yourself and Caroline. That's Ed Ludlow on the Amazon story. So the world's second largest maker of computer processors, giving a lukewarm forecast. It's AMD. The stock is slumping after delivering weaker than expected forecasts. Abigail Doolittle has the narrative, down 7.5%. That's a brutal response, Abby.
Indeed. The stock is heading to its worst day in about a month, having to do with that tepid forecast that you talked about, plus a lukewarm quarter that they just reported, numbers basically in line. So the gangbusters growth that they had for some time not happening. A big piece of this are gaming chips, or weaker demand there than expected. They put up overall $5.7 billion worth of revenue, or excuse me, the expectation for this quarter is $5.7 billion worth of revenue versus the street of $5.72 billion. Not a huge shortfall, but given the fact that this stock has been up 75% over the last year, I think that that's really weighing on the minds of investors that they want strong demand everywhere. Speaking of, AI is expected to boost projections in the future, perhaps though just not in this current quarter that we're in. That's a little bit short of the street. And this, of course, also follows Intel last week giving a tepid forecast. So it seems like some of these big chip companies struggling, Manus.
Okay, Abby, thank you very much. Great roundup. Abigail Doolittle there. Let's turn our attention to Tesla, the EV maker, axing almost the entire supercharger team, cutting nearly 500 jobs. Now, this is continuing to be a tumultuous year for the company. Craig Trudell joins me. I mean, this sort of defies logic for me, Craig. The whole paradigm shift is to make it easy for me to plug in, believe I can go anywhere, and here we go. Supercharger looks as if it's something in the rearview mirror for Tesla and the industry.
Yeah, I think that last bit is really key because, you know, it'd be one thing if this was just a story that is detrimental to Tesla. I think we would maybe be able to chalk this up as, you know, Elon Musk being Elon Musk and you know, making moves that, you know, are going to help or hurt Tesla. In this case, it's really a move that has the potential to be very disruptive to the broader industry, just given that we're only a few months into car makers like Ford embracing Tesla's superchargers and, you know, even redesigning their vehicles going out years so that Tesla's plugs work with their ports. And so some real questions here about, you know, just how disruptive this is going to be to the future of this network that has been hugely valuable to Tesla and to the broader EV ecosystem.
Craig, thank you very much. The stock slither lower after yesterday's little bit of a shakedown. Okay, Craig Trudell there on the Tesla story. What have we got? We've got some signs of a slowing consumer. Starbucks sales falling for the first time since 2020. A budget-conscious consumers tightening up their belts. Let's get to Isabel Lee on the health of the consumer. These are idiosyncratic moves. You've got McDonald's, you've got Starbucks. Pull it together for me.
It may just really tell a broader picture, Manus, and this is in the face of half-off deals in Starbucks and a lot of new products like lavender oat milk latte. And investors really are feeling jittery because shares are down around 14%. This is the most since 2020. We're seeing the biggest drop there since the early onset of the pandemic. So the company reported a 4% decline in same-store sales, which is a key metric for growth. And this is despite analysts' forecasts of a gain. We also saw overall number of transactions falling around 6%. And during the call, we have the company cutting its full-year revenue growth forecast and saying that adjusted EPS may be flat. And even the analyst comments weren't that good. We have Vital Knowledge saying that this might be the worst set of results from any company so far this quarter. And we have William Blair downgrading the stock, saying that the stunning across-the-board miss on all key metrics is just noteworthy. So Starbucks has really struggled to keep up with lofty expectations as it enters a new leadership. We have the CEO who has just been in the job a little more than a year, and since then he has already lowered guidance several times. The CFO actually put it more bluntly. He said that they weren't happy with the results this quarter, but that they have a path moving forward. So we'll see where that path really goes. But for now, it just really underscores the challenge of $6 lattes as we see rising inflation. Shares are still lower, and year to date, Starbucks shares are also down 20%, Manus.
Well, the consumer votes with their feet because there's always a coffee shop within short distance of your neighborhood Starbucks. Isabel, thank you very much, Isabel Lee. Let's get back to the macro picture, the U.S. economy as a whole. Troy Gayeski is with FS Investments, and he says this: remember, the U.S. economy is like an aircraft carrier or a ginormous cruise ship. It takes a tremendous amount to force it to turn meaningfully away from the steady state, growth up or down. Guy is with me now. So look, this, Troy, here we are. The steady state of the U.S. is strong, resilient, with sticky inflation. So my question to you is, with that consequence in mind, no rate cuts potentially this year, do you still remain fully and firmly overweight U.S. relative to the rest of the world?
Well, it depends. I mean, the issue for the U.S. is not growth, right? When you look at broader markets, and obviously we have the global champions in technology. You went through a lot of the earnings, obviously very strong earnings. For the most part, a few disappointments. The issue has really been multiples. That's what we've been grappling with. A lot of others have been grappling with. What's the appropriate multiple given the free cash flow generation power of a very narrow market? And when you think of the path, we were at 21.2 times coming into the pandemic, dropped to 15.75, reflated back up to 21. And given the fact that obviously bond yields have gapped higher and there's really very little hope for the Fed to bail anyone out anytime soon, we're through another round of multiple compression. So I think the question for investors is, where do you get growth? It's obviously in the U.S., but then how do you execute it? And most investors already have healthy exposure to market cap weighted indices. So one of the areas that we're really focused on now is middle market private equity, where you're getting growth at a reasonable price. And as long as we can avoid a recession, you can compound EBITDA at 15 to 25%. You're going to have very good outcomes for investors over the years.
What proportion? I mean, if you look at the classic destruction of everybody's life is 60-40, battered and bruised by 60-40. And you make this point, 60-40 was a correction in the summer of last year. Here we are again. We're waking up. We've got 2s over 5%. We've got 10s careering towards 475. So therefore, are you actively reallocating away from 60-40? And what portion of that then should be private equity?
Yeah, so it really depends on the client, right? No client's the same. Obviously, there are a lot of investors that
let's just take a moderate risk. Let's just take a moderate risk, high net worth individual with money to deploy who wants a return more than 5.25% in a CD.
Yeah, so look, the greater wealth management channels, the Morgan Stanleys, the UBSs of the world, are recommending somewhere between 20 to 30% in alternatives. And within those models, usually it's 5 to 15% in private equity, depending upon, again, their risk tolerance, their age, their liquidity position. And so that's really the direction we're going in. Right now, the penetration rates are only 4 to 5%. So there's a very long window for investors to not necessarily catch up with the Yales or, the larger institutions, but make it a much more meaningful part of their portfolio. And, when you think of the use cases, really, from 2017 up until today, the primary use case has been to replace or complement fixed income. What we're seeing much more now is the urgency to deploy cash, but do it in a way where you're not taking uncomfortable levels of risk, can walk into a duration-related drawdown or another period of multiple compression. So, the outlook looks very bright, but again, no strategy is perfect. You are sacrificing liquidity. There are lockups that are associated with these strategies.
Look, we're counting down to Chairman Powell later on this evening. You identify the risk is either an endogenous shock or an external shock. You make it very, very clear that it's one or the other. It's endogenous or exogenous. I just wonder to what extent could we have an endogenous shock tonight? In other words, the removal of some kind of language from Powell about the risk of rate cuts, no rate cuts this year. In other words, moving away from at some point this year. Is that just too high a left tail risk?
Yeah, so when you think of the most likely endogenous shock coming within the system right now, it's the continued drainage of the balance sheet. There was a lot of expectation that the Fed would start announce a taper at this meeting and start slowing the pace of that balance sheet drainage. Given how hot the inflation data is, that could be pretty challenging to do right now. So as that liquidity is drained, the reverse repo facilities drop from well over $2 trillion to right around $500 billion. And you look at the issuance, the massive levels of issuance that we're having in the Treasury market, it's very easy to imagine some type of shock that hits Treasury yields where you gap up to 5.5% or maybe even 6% briefly. So that's the most obvious endogenous shock that we see. Hopefully the Fed gets it right. They've already drained or taken a third of the balance sheet expansion that they did in the pandemic off. Money supply has been stagnating really since Q1, Q2 of 2022. So that's the most obvious endogenous shock for markets. Fortunately, that will more than likely have a more negative impact on markets than the real economy, because as you quoted me before, it takes very powerful forces to move the economy away from that 1.5% real growth rate, which is what we're settling into now. It's just nominal growth is still too high for the Fed's comfort zone.
But this is the battle, isn't it, between QT and the Treasury at issuance and the function of QT. I mean, just run it past me again as to what could spike me up to 5.5%. What is the risk? Is it about the issuance comes out of sequence to what we think it's going to be, just materially higher?
Yeah, so you put yourself back in September, August of last year.
Yeah.
One of the key drivers of why yields gapped higher is issuance levels were coming in far, far, far higher than people expected. And you had almost a borderline panic in the Treasury market where yields gapped higher. And then mainly for technical reasons, because almost every macro manager was massively short the back end of the curve, you started to have a short covering rally that was justified by, issuance is a couple billion lower than we expected, so this is great. And it's like, no, it's not. It's not great. It's technicals driving, yields back lower. So we had another kind of bullish move in the Treasury market. But where we sit now, obviously the inflation data is not beneficial at all. The probability of the Fed not cutting at all this year has gone up dramatically. And if we keep having these over-expected issuance levels, it's definitely a possibility to see yields make new highs in this cycle, which most investors just aren't prepared for, unless, of course, they've embraced alternatives in a democratized way.
Yeah, you see, plug in the alternatives. Tell me this. I mean, we're debating. No, you're okay. The consumer, I mean, UBS, the hedonism of the consumer, beautiful phrase from Paul over there. But here we are. The consumer is choking at Starbucks, reluctant at McDonald's, and searching for deals on Amazon. It's changing, isn't it? There is something changing in the consumer, and I can't quite put my finger on it.
Yeah, so this is one of the areas where the macro ties up to the micro from an earnings standpoint. So, when you think about one of the key reasons why we didn't have a recession in 22, when every single factor that contributes to GDP went negative, it's because consumption was still so gosh darn strong because of the excess savings and the white hot labor market we had.
Yep.
So what's really happened is, excess savings have been completely run down, particularly for, the lower 5 deciles of the income population. The labor market has deteriorated from, let's call it white hot, to somewhere between warm and red hot. And so you have seen the crack show up in the lower income consumer, whether you look at auto defaults or credit card default rates. So we've been following that for quite some time, and now you're starting to see it show up in earnings, as you point to McDonald's and Starbucks in particular. So the consumer is in good shape, but there are cracks. The consumer is clearly not as strong as the position they were in 2022 or 2023. So when you think about from a risk management standpoint, what that really means is if there is some type of meaningful endogenous or exogenous shock.
I think it's going to come down to whether those cracks spread out in breadth and depth in the consumer. Troy, thank you very much for being with me. Troy Gayeski, there of FS Investments Market Strategy on Bloomberg. Context matters. Well, MasterCard are out with their results. The shares are down after it cut the forecast for revenue for the year. Joining me now is Jess Menton with the details. Now, the cut in itself, we need to talk about the scale of that cut and the data behind that. Just disaggregate it for me.
That's right. So looking at this stock for MasterCard, ticker symbol MA on this, that stock's down about 2%. So this would be on pace for its worst day since February 20th. But when you look overall, what really you're seeing within the numbers, you're still seeing strong consumer spending there. It was when you're looking at network spending, that was what specifically missed estimates. So they ended up putting out some guidance here. They're looking at growth and net revenue is expected to be at the low end of low double digits for all of 2024, compared with prior guidance for growth at the high end of low double digits. If you want to look at some of its peers, though, in the S&P 500, in the payments processing sub-industry group in the S&P 500, that's down about 1%. So obviously it has peers like Visa and PayPal in that as well. But of course, you do have MasterCard and then also Capital One, because they're going to have that acquisition of Discover Financial that would create the biggest credit card issuer here. And of course, one of those cards that they issue is MasterCard. So the company has said that they will comply with those changes that are going to happen here. But if you look at its peers, though, Visa also beat on earning estimates. And then you have American Express. It did see revenue jump about 11% in the last quarter. If you look over at the A&R function for MasterCard, you have about 41 buys, you have 4 holds, and 0 sells right now. And so really looking at total network spending volume around $2.3 billion for the first quarter. That was up about 8.6% from a year earlier. But unfortunately, that didn't miss estimates, Manus, for about $2.1 trillion.
Okay, Jess, and as you said, one of the biggest issues is Capital One paying up $35 billion for Discover Financial. It's going to change the landscape. More on that, I'm sure, as the deal flows in. Jess Menton. Well, S&P Global US Manufacturing PMI, the numbers have hit the tape. Mike McKee is with me to break them down. He's had a lot of work to do. He's had ADP, he's had auctions. What have you got for me on this data?
We've got an awful lot of economic data coming today, Manus, ahead of the Fed meeting. And the latest is the S&P Global Manufacturing PMI, which rises above the contraction level, hits 50 exactly. Last month it was at 49.9. Now, this sort of sets the table for the ISM report coming up at the top of the hour. ISM also expected to come in at 50, although that would be a slight decline from 50.3. Be much more interested to see the prices paid number and perhaps the employment number for ISM. We'll watch for those and have those for you at the top of the hour.
So what's the betting now on the dropping of the language of rate cuts, guidance on easing at some point this year? It would be quite visceral if that was removed from Chairman Powell's narrative this evening, Mike, wouldn't it?
Yes, I think they're going to try to avoid that and say that they still think, essentially, as that statement puts it, that they could cut rates this year, but they're not really going to want to go out on too much of a limb because they're starting to become very unsure about it. What'll be interesting is what Jay Powell has to say about it, whether he admits the possibility of raising rates at all. Some people thinking that might be in the cards this year.
Okay, that certainly would be something that could punch those yields up to 5% on the 10s and take us to new highs through the 2s. Mike, thank you very much. Mike McKee will track all of that. And of course, we've got a Fed special for you a little bit later on today. Abigail Doolittle is with me with some of the sector price action. Abby.
And we're looking at a second down day in a row. Most sectors for the S&P 500 are lower, suggesting that there's a broad-based decline here. The worst sector, staples, down about 1%. Mondelez, the big drag there. But tech is also down sharply, down 0.6%. On the other hand, consumer discretionary being helped out by Amazon, up about 0.75%. The oil and services sector, though, this week so far, Manus, down about 4%. This as oil has fallen nearly 10% over the last couple of weeks.
Okay, Abby, thank you very much. Coming up, your market moving events. We're going to set your clock by a trading diary. And guess what? Part of that will be a Fed special right here on Bloomberg. What we've got in your trading diary for the rest of the week, we get Jolt's data at 10 a.m. Eastern, top of the hour, and then it is the Fed decision at 2 p.m. Eastern. We'll have Fed surveillance special for you at that. The press conference is at 2:30 p.m. Then countdown to Apple after the closing bell. Truth and reconciliation moment on China. That takes us through to Friday and the jobs report in the United States of America. That was Countdown to the Open with me, Manus Cranny from New York. A very good morning.